Okay, let's unpack this. Imagine settling in for your Sunday brunch, perhaps scrolling through the news, and suddenly the financial headlines just jump out at you.
Hmm.
The week we're about to dive into, the tumultuous final week of July 2025, wasn't just another blip on Wall Street. It was a brutal, decisive turning point.
It really was.
What began with calm confidence, I mean, even setting new record highs for major U.S. equity indices,
Ah,
ended in a dramatic and, frankly, a shocking reversal.
yeah, quite the turnaround.
We're talking about the most severe losses for the S&P 500 and Nasdaq since mid-May, marking a profound shift in market sentiment. So, what exactly caused this sudden and violent shattering of optimism that week?
What's truly fascinating here, I think, is that it wasn't a single isolated event, a lone black swan. It was more like a perfect storm.
Okay.
This was a confluence of three powerful, interconnected forces that converged and hit the market in rapid succession, creating this sort of cascade effect that, well, few anticipated.
Right.
In this deep dive, we'll extract the most important nuggets from our sources, including the weekly market and commodity analysis report, to help you understand not just what happened,
Right.
but why it happened, and, maybe most importantly, how these forces fundamentally repriced risk for investors globally.
Okay.
It's a crucial case study in how quickly sentiment can shift from, serene confidence to palpable fear. And, yeah, perfect topic to mull over as you enjoy your Sunday.
Absolutely. Let's get into it. This deep dive is all about understanding that dramatic shift. It genuinely felt like the music of a serene bull market just stopped.
That's a good way to put it.
On Monday, July 28th, the S&P 500 was still hitting its sixth consecutive record close, right? A testament to the prevailing optimism.
Exactly. And the NASDAQ composite, not to be outdone, secured its 10th record in 11 days.
Incredible. There was this prevailing picture of a bull market truly in command, almost a sense of, I don't know, tranquility.
Yeah. Complacency, perhaps. Investors were comfortable, maybe too comfortable, believing that growth would continue and any trade issues would be managed.
But by Friday, August 1st, that picture had completely changed. It gave way to this unexpected torrent of selling.
It really did.
So by the end of that tumultuous week, what did the final score truly look like for these major indices? And what does it tell us about the speed of this market's repricing?
Well, if we connect this to the bigger picture, the initial optimism that had carried over from the previous week didn't just fade.
No.
It dissolved into a sustained and accelerating sell-off that completely overwhelmed any positive corporate earnings reports that came out during the week.
Right. The good news just didn't matter.
Exactly. It was truly a tale of two distinct and opposing narratives playing out within just 5 trading days. The S&P 500's 2-week winning streak was decisively snapped, and the market found itself on an entirely different footing by Friday afternoon.
Okay, so let's break down the numbers. How bad was it?
Let's break down the precise numbers and, importantly, the sheer velocity of this decline for you. The S&P 500, the SPX, it didn't just tick down.
Right.
It plunged by 2.36% for the week. That translates to a staggering drop of 150.63 points, closing at 6,238.01.
Wow.
And to put that in stark perspective, this represented its largest one-week point and percentage decline since the week ending May 23, 2025.
Okay, so biggest drop in a couple of months then.
Exactly. And remember, it began the week at an all-time closing high of 6,389.77 on Monday,
Right, the peak.
only to fall for 4 consecutive trading days, ultimately ending at its lowest level since July 8th. This wasn't a gentle correction. It was a steep, sustained retreat from peak valuations.
And the Dow, how did it fare?
The Dow Jones Industrial Average, the DJIA, fared even worse. It tumbled between 2.9% and 3.1% for the week,
Ouch.
making it its most significant weekly loss in 4 months. Closed Friday's session at 43,588.58, shedding over 500 points on Friday alone.
500 points on Friday.
Yeah. This indicates the broad-based nature of the sell-off, impacting even the venerable industrial giants.
And even the Nasdaq couldn't escape, despite starting strong.
No, even the NASDAQ composite, the IXIC, despite starting the week with its 10th record close in 11 sessions, couldn't escape the downdraft. It slid 2.2% for the week, closing at 20,650.13. Like the S&P 500, this was its worst weekly performance since mid-May, underscoring just how broad this sell-off was. It impacted even the market's leading growth-oriented tech companies that had seemed, well, almost invincible only days before.
So this wasn't just a slight correction, was it? It sounds like a total, almost violent shift in perception, as if the very foundations of market confidence were suddenly shaken.
Absolutely not a slight correction. The velocity of this reversal is particularly telling, and it speaks volumes about the nature of the shock.
How so?
Well, a market that simply drifts lower suggests a gradual absorption of new information,
Mm.
right? A slow recalibration. But what we witnessed was a market that plunged from all-time highs to its worst week in months. That signifies not a gradual adjustment, but a fundamental, sudden shock.
Right, like hitting a wall.
Exactly. Think about it. The prevailing thesis on Monday was one of resilient economic growth, robust corporate profits, and trade disputes being carefully managed.
Through negotiation, targeted deals.
Precisely. But the events of the subsequent days, culminating in Friday's bombshell jobs report and that sweeping tariff announcement, directly assaulted all three pillars of that optimistic thesis.
Ah.
That rapid four-day decline wasn't just a movement of prices, it was the market violently repricing for a new, much more uncertain reality.
A much scarier reality.
Yes. This new reality includes the rising potential for a sharp, trade-induced economic slowdown, or even worse, a stagflationary environment.
Which is the worst of both worlds, right? Slow growth and rising prices.
Exactly, the unwelcome combination. It was a complete and abrupt mental shift for investors. The ground rules seemed to change overnight.
And it wasn't just here in the U.S., was it? Did this fear spread globally, creating ripples across international markets?
Oh, absolutely. The risk-off sentiment was by no means a localized U.S. phenomenon. The contagion spread rapidly, demonstrating the deep interconnectedness of global financial markets.
So, Europe, Asia.
European and Asian stock markets declined in tandem, mirroring the U.S. downturn. Investor sentiment was significantly dented by the U.S. trade developments, which of course have direct and often painful implications for their export-oriented economies.
Makes sense?
For instance, the MSCI EAFE index, that's a broad benchmark for developed international markets, it fell 2.8% for the week, almost perfectly mirroring the losses we saw in the United States.
Wow, lockstep.
It indicates a synchronous global reaction to the unfolding events.
Any particular areas hit harder?
Indian markets, specifically, were hit especially hard. The BSE Sensex, India's benchmark index, tumbled sharply on Friday after the White House reaffirmed a 25% tariff on Indian goods.
Ah, that specific tariff news.
Exactly. This immediately stoked fears across India's crucial pharmaceutical and automotive sectors, which rely heavily on exports.
And you could feel the fear, right? Like the VIX.
Oh, yeah. This palpable shift in psychology, this sudden return of fear, was vividly captured by the CBOE Volatility Index, the VIX, often called the market's fear gauge.
Mm-hmm.
The VIX represents the market's expectation of future volatility, derived from options pricing. It had been relatively subdued, reflecting that earlier complacency.
Right.
But it surged dramatically during the week, signaling that investors weren't just reacting to current losses, but actively bracing for even bigger, more unpredictable swings ahead.
How much did it jump?
One report noted an 11.9% jump in the VIX in pre-market trading on Friday alone,
Wow.
which was a very clear, unequivocal signal that market complacency had been decisively replaced by significant anxiety among investors. They were now demanding a premium for holding risky assets.
So what does this all mean for you as you consider the global economy this Sunday? It means understanding that sometimes the market's internal story shifts dramatically, not just day to day, but week to week, creating ripple effects across the globe that can impact economies far beyond our own borders, and ultimately even affect your own investments or the price of goods you buy.
Absolutely. The interconnectedness is key.
Now, let's turn to the first major force that contributed to this perfect storm. The U.S. Federal Reserve finding itself in an exceptionally difficult, almost untenable position.
Right. The Fed's role here is critical.
What was happening with the Fed midweek? Why was it so significant that it sent such a profound signal to the market even before the week's bombshell data hit?
This raises an important question about central bank agility, right?
Mm.
Their ability to react in real time to rapidly evolving economic conditions.
Yeah.
So on Wednesday, the Federal Open Market Committee, the FOMC, concluded its July meeting. As was widely expected, they held their benchmark interest rate steady, in that range of 4.25% to 4.50%.
Okay, no surprise there.
No. And in his press conference, Fed Chair Jerome Powell maintained a cautious tone, reiterating the committee's wait-and-see approach.
Still waiting and seeing.
Exactly. He specifically noted uncertainty around the impact of tariffs on inflation and gave no clear indication that a September rate cut was imminent. Initially, his remarks were perceived as maybe hinting that rates might stay elevated for longer.
Which wasn't what the market wanted to hear.
No, it briefly dampened market hopes for any near-term easing of monetary policy. It reinforced a narrative of continued vigilance against inflation.
But that wasn't the real story from that meeting, was it?
No, exactly. The most critical detail from that meeting was not the decision itself, which was broadly anticipated, but the revelation of a significant, almost unprecedented internal rift within the committee.
A rift. How so?
The policy statement explicitly revealed that two governors, Michelle Bowman and Christopher Waller, had actually dissented from the majority decision.
Wow. Dissenting votes at the Fed are rare.
Very rare at the governor level like this. And both of them favored an immediate 25 basis point rate cut.
So they wanted to cut then?
Yes. This was a truly remarkable event because it marked the first time since 1993, that's over 3 decades ago, that two Fed governors had dissented on a policy vote.
That's a huge deal.
It is. This wasn't just a simple disagreement. It was a rare public fracturing of consensus within the Fed's highest ranks. It signaled to the market that even the most informed economic minds were at odds over the true state of the economy and the right path forward.
Undermining confidence in their united front.
Precisely. It undermined the Fed's traditional united front, introducing a new layer of uncertainty about its ability to provide clear guidance and, crucially, about the reliability of its own internal data interpretations. It suggested that even within the Fed, there was no consensus, which is deeply unsettling for a market that craves clarity.
Okay, so the Fed was already showing cracks in its consensus, a rare public dissent signaling internal turmoil. But then came the bombshell jobs report on Friday.
Yes, the Friday report.
How did this report fundamentally alter the perception of the U.S. economy and essentially corner the Fed, forcing its hand in the eyes of the market?
Well, what's fascinating here is how the data painted a dramatically different and far more concerning picture than the one the Fed seemed to be operating on just 2 days earlier.
Right.
It made their cautious stance look entirely out of sync with well, the true economic reality. Friday's employment report for July was not just disappointing, it was a bombshell. It fundamentally altered the perception of the U.S. economy's trajectory.
And vindicated the dissenters.
Retroactively, yes. It validated those dissenting voices at the Fed.
Okay, give us the numbers. How bad was it?
Let's look at the numbers and understand their profound implications. The headline figure was undeniably weak. The economy added only 73,000 jobs.
Only 73,000? What was expected?
Well below consensus estimates that had ranged from 95,000 to 104,000. So a big miss just on the headline.
That's bad enough.
But the truly devastating news, the real shocker that reverberated through the market, lay in the revisions to prior months.
The revisions. I heard they were bad.
They were staggering. The job gains for May and June were revised down by a combined 258,000 to 260,000.
250,000 jobs. Gone.
Just vanished from the previous estimates. Think about that for a moment. Over 250,000 fewer jobs than we thought had been created in the 2 preceding months.
So the slowdown was already happening, we just didn't see it.
Exactly. This revealed that the labor market had actually been decelerating sharply for months, a fact that was previously masked by overly optimistic initial reports. This wasn't a sudden slowdown. It was a deeper, more persistent weakening than anyone had realized.
Any other details? Unemployment rate? Sectors?
Yep. Adding to the concern, the unemployment rate ticked up from 4.1% to 4.2%. And the report showed tangible weakness in key sectors. Manufacturing shed 11,000 jobs. Federal government employment fell by 12,000. It signaled a broad-based softness.
And were there other economic indicators released during the week that supported this weakening picture, perhaps even adding to the market's sense of unease?
Yes. Other economic data released during the week painted a similarly mixed to weakening picture, contributing to the growing macroeconomic uncertainty.
Like what?
Well, the advanced reading of Q2 GDP came in stronger than expected at plus 3.0%.
Oh, that sounds good.
But, and this is a big but, this figure was largely due to volatile trade and inventory effects, not necessarily robust underlying demand or long-term growth.
Okay. So not necessarily sustainable.
Right. And more forward-looking indicators were particularly troubling. Construction spending, for instance, fell for the 6th consecutive month.
6th month, that's a trend.
It's a worrying trend. It suggests a decline in long-term capital investment, a lack of business confidence to embark on new projects.
Okay.
Furthermore, June's JOLTS job openings, that's a crucial measure of hiring intentions and labor demand, declined to 7.437 million, falling short of the 7.55 million expectation. It suggested companies were already pulling back on hiring plans.
And what about inflation? Was that falling too?
That's where it gets tricky, adding a potential stagflationary concern to the mix. Core PCE prices.
The Fed's preferred measure.
Exactly, because it strips out volatile food and energy. It saw its largest monthly gain in 4 months at 0.3% month over month.
So prices still rising even as jobs weaken.
Precisely. It suggested that prices were still rising even as growth was clearly slowing. Not a good combination.
So the dissent, then the jobs report. How did this impact the Fed's credibility?
Well, the combination of the dissent on Wednesday and the bombshell jobs data on Friday created a powerful and undeniable narrative that left the Fed looking, frankly, vulnerable.
Behind the curve.
Exactly. The massive downward revisions meant the labor market was already decelerating sharply, while the Fed's leadership was publicly advocating for a wait-and-see approach. The discrepancy was glaring.
So their own data didn't match their stance.
Essentially, yes. The Fed's midweek caution, their wait-and-see approach, was built on a data picture that Friday's bombshell jobs report completely obliterated.
Which, as you said, made the dissenters look right.
It retroactively vindicated the dissenting governors, making them appear prescient, while Chairman Powell, unfortunately, appeared to be behind the curve, slow to acknowledge the deteriorating reality.
That can't be good for market confidence.
No, it created a significant credibility issue for the Fed. It forced investors to conclude that the central bank may have stuck to its wait-and-see stance a little too long. This perception of a slow-moving or misinformed central bank can erode market confidence rapidly. It leads to aggressive repricing by investors who lose faith in official guidance.
So what does this all mean for you as someone trying to understand the economy and how its signals are interpreted? It highlights how absolutely crucial accurate data and its revisions are.
Absolutely critical.
And how central banks can find themselves caught between different economic signals and political pressures, sometimes appearing to be reactive rather than proactive. This fundamental reassessment of the economic landscape directly led to the great repricing of interest rate expectations, right?
This raises an important question. How quickly and dramatically did the market react to this new, sobering economic reality, especially after the jobs report?
Certainly.
Pretty much. The bond market's reaction was swift and severe, immediately reflecting these new conclusions about the Fed's predicament and the economy's trajectory. It was nothing short of a complete overhaul of the rate outlook.
So yields fell sharply.
Treasury yields, which move inversely to prices, plummeted across the curve in response to the jobs report. The policy-sensitive 2-year Treasury yield that's particularly sensitive to Fed expectations for short-term rates fell by approximately 21 basis points over the week.
Okay.
But the most aggressive repricing occurred in market expectations for future rate cuts.
What did those odds look like?
The market implied probability of a 25 basis point rate cut in the September FOMC meeting surged from around 37–39% before the jobs report was released to as high as 84% afterward.
Wow. From about 1 in 3 to almost certainty in a day.
Think about that. Yeah, the likelihood of a September rate cut more than doubled in a single day.
It's incredible.
Moreover, the total number of rate cuts expected by the market for 2025 jumped from 1.36 to 2.26, also in a single frenetic day of trading.
So now pricing in more than 2 cuts.
Yes. This wasn't just a minor shift in expectations. It was an aggressive pricing in of a Federal Reserve that the market now believes will be forced to capitulate.
Forced to catch up.
Exactly. Catch up to an economic reality that is suddenly much worse than its public statements had acknowledged. It indicates a market that decided the Fed was behind the curve and would now have to play catch-up to avoid a more severe economic downturn, essentially forcing the central bank's hand.
Okay, so the weak jobs report was a seismic event, a genuine macroeconomic earthquake that shook market confidence to its core.
And it definitely was.
But it wasn't the only one. Just as the macroeconomic picture darkened, a geopolitical shockwave delivered the final crushing blow.
Right, the trade front exploded.
We started the week with what seemed like promising, even positive trade developments, almost a sense of detente.
There was some optimism early on, yes.
Yeah. But that fragile optimism was utterly obliterated by its end. Here's where it gets really interesting, showing just how quickly the global rules of the game can change.
Indeed. And this demonstrates how quickly policy can pivot and how dramatically such a pivot can alter the global trade landscape and, by extension, market sentiment.
So what were those positive developments early in the week?
The week truly began with what seemed to be positive developments on the trade front, fostering a sense of calm and predictability. The United States had finalized trade agreements with key allies, including the European Union and Japan.
Okay, deals with allies. That sounds constructive.
Right. These deals were significant because they established a 15% tariff rate on many goods, including critical sectors like autos. This was widely seen as a clear step toward resolving ongoing dispute
And providing clarity.
and, crucially, providing much-needed clarity for businesses, allowing them to plan their supply chains and investments with more certainty. This progress fueled the market's early week optimism.
Suggesting a more targeted approach.
It suggested the administration was pursuing a more transactional, deal-making approach to trade policy, resolving issues one by one through negotiation rather than broad confrontation.
So if the week began with movement towards resolution and clearer trade lines, what happened next? How did we go from handshakes and deals to what felt like a global trade war in a matter of days?
That initial optimism was utterly obliterated late in the week, in a stunning and completely unexpected escalation.
When did this happen?
On Thursday, President Trump issued a sweeping executive order.
Sweeping how?
This order imposed tariffs ranging from 10% to as high as 41% on imports from a staggering 92 different countries.
92 countries.
Yes. This wasn't a targeted measure. It transformed the administration's trade policy from a series of targeted disputes with specific nations into a broad, indiscriminate global trade conflict.
Wow. And the market reaction?
Immediate and unequivocally negative. Futures declined sharply as the news broke. It was a complete and abrupt shift in strategy.
From scalpel to sledgehammer.
Exactly. Moving from a scalpel approach, seen in the deals with the EU and Japan, to a sledgehammer, targeting almost half the world. Investors realized that the era of managing trade disputes individually was over. A new, more chaotic phase had begun.
Can you give us some details on this new tariff regime? How significant was it, really?
The details truly underscored the severity of the escalation and its historical significance. According to a swift analysis from the Yale Budget Lab,
Okay.
these new tariffs were projected to raise the overall average effective U.S. tariff rate for approximately 2%.
Which is pretty low historically.
Very low, to a staggering 18.3%.
18%? That's huge.
To put that in historical context, this is the highest level seen since 1934, harkening back to the protectionist era of the Smoot-Hawley Act,
Which didn't end well.
which is widely considered to have deepened the Great Depression.
Yeah. Any specific countries hit particularly hard?
Specific trading partners faced particularly harsh treatment. Tariffs on Canadian goods, for example, were increased from 25% to 35%, a significant blow to cross-border trade.
And India. You mentioned them earlier.
India, where trade negotiations had reportedly stalled, was hit with a substantial 25% tariff on its goods, immediately impacting vital sectors for their economy, like pharmaceuticals and automotive parts.
That's an enormous jump, moving from 2% to over 18% on average tariffs. What are the real-world economic implications of tariffs at that level, particularly for the average American household?
Well, the economic implications of such a sweeping move are profound and immediately tangible, impacting everything from consumer prices to business investment.
How so?
The Yale analysis projected that these tariffs would lead to a 1.8% increase in the overall price level across the U.S. economy.
Okay, 1.8%. What does that mean in dollars?
To translate that into something more concrete for you, this is equivalent to an average income loss of $2,400 per U.S. household annually.
Wow, just eaten up by higher costs.
Exactly. Your purchasing power is eroded. And the impact was expected to be disproportionately felt on everyday consumer goods. For example, prices for items like shoes and apparel were projected to potentially rise by a massive 38–40% in the short term.
38 to 40% on shoes and clothes.
A direct hit to discretionary spending.
Yeah. So this policy whiplash you mentioned.
Yes, this policy whiplash from a perceived de-escalation with allies to a broad-based attack on global trade is a critical factor in understanding the week's market collapse.
Scalpel to sledgehammer again.
Exactly. The early week deals with the EU and Japan represented a scalpel approach, suggesting a desire for negotiated resolutions. The late-week executive order targeting 92 countries was a sledgehammer, suggesting a willingness to create widespread disruption.
So investors couldn't assume resolution anymore.
No. This strategic contradiction means that investors can no longer price in a best-case scenario where trade disputes are resolved one by one. Instead, they must now price in a much higher probability of a chaotic and prolonged global trade war, a deeply unsettling prospect.
And the impact on businesses.
This renewed and intensified uncertainty acts as a direct tax on business investment and consumer confidence. We saw this immediately in the data.
Like the manufacturing jobs number.
Exactly. The manufacturing sector, highly sensitive to trade policy and supply chain stability, clearly felt the impact, shedding 11,000 jobs in July. That's a direct consequence of factories halting orders, rethinking their global supply chains, companies reconsidering expansion plans.
Changing the rules mid-game.
Think of it like that, yes. That's how businesses felt with the new tariff regime. They simply didn't know what the rules of the game would be tomorrow.
And construction spending falling, too.
Similarly, construction spending, reflecting long-term capital investment decisions, declined for a sixth consecutive month as businesses simply deferred major projects, unwilling to commit capital in an environment where the rules of global trade could change overnight.
So the tariffs explain the weakness we saw earlier.
The tariff escalation provides a clear explanation for this weakened hiring and delayed investment decisions as businesses pull back in the face of an unpredictable and hostile global trade landscape.
This isn't just a blip, then.
No, it's a fundamental reevaluation of long-term strategic planning, potentially leading to persistent underinvestment and slower job creation across industries reliant on global trade.
So what does this all mean for you as you think about the broader economy and your own finances? It means recognizing that trade policy isn't just about abstract global relations debated in distant capitals.
Not at all.
It has very real, tangible effects on your wallet, the prices you pay at the store, and the stability of businesses you might work for or invest in. It truly brings the global down to the individual grocery bill.
Absolutely. Very direct impact.
The turmoil of the week was incredibly evident, almost viscerally so, in the commodities market, which saw dramatic and often divergent moves.
Yeah, commodities were all over the place.
We had powerful cross-currents driving everything from industrial metals, the very backbone of manufacturing, to agricultural goods, which feed the world. Given the sheer scale of some of these movements, let's start with the biggest loser, a story that truly encapsulates the week's policy whiplash.
Right. This raises an important question. How can a single, seemingly technical policy announcement cause such a violent and immediate reaction in a specific commodity market,
Triggering a massive unwind.
effectively causing a multi-billion-dollar trade to unravel in minutes? Yeah.
Yeah.
The most dramatic story unfolded in the copper market. It experienced what was described as a historic repricing event.
Historic repricing sounds bad.
The price of U.S.-traded copper didn't just fall, it collapsed.
Why? What was the trigger?
It was a direct result of a stunning policy U-turn from the White House regarding a new 50% tariff on a range of copper-intensive goods.
Okay, a big tariff.
But and this is the crucial part, with a surprising and very specific exemption for refined copper.
Ah, the traded form.
Exactly. The primary form traded on global exchanges like COMEX in the U.S. and LME in London.
So the policy missed the main target.
Well, it caught markets completely off guard.
Yeah.
In the weeks prior, traders had been building up a massive arbitrage position based on the expectation of a comprehensive tariff on all copper products.
Explain that arbitrage trade again.
Arbitrage is essentially a bet, right? A strategy where traders try to profit from a price difference for the same asset in different markets.
Okay.
In this case, they were strategically buying U.S. COMEX copper futures and simultaneously selling London LME futures.
Betting the U.S. price would soar relative to London.
Exactly. Betting a comprehensive tariff would cause the U.S. price to skyrocket relative to the global price. This trade had driven the premium for U.S. copper over London copper to historic highs.
A profitable trade for a while.
It was even described by one analyst as one of history's most profitable commodity trades, netting immense profits for those who initiated it early.
Until the exemption.
Until the exemption. When the White House announced the exemption for refined copper, the entire premise of this highly profitable trade was instantly invalidated.
Like pulling the rug out.
Exactly. Traders were forced to unwind their positions en masse, desperately selling their U.S. copper contract to close out the trade. This created an avalanche of selling pressure.
Then the result?
A record 22% plunge in COMEX copper futures in a single session.
22% in one day.
Yeah. That massive price premium that U.S. copper held over the LME vanished almost instantly. The spread collapsed into a discount.
Wow.
The copper market collapse was a textbook case study in policy whiplash. It demonstrated how, in a tariff-driven market, policy risk can completely overwhelm all other traditional fundamentals like construction demand or supply disruptions.
So it wasn't about supply demand at all.
No, the price move had little to do with underlying supply and demand for copper. It was a violent unwinding of a speculative trade built entirely on a specific policy expectation that was then invalidated.
That's incredible. A single policy decision causing a commodity to plummet 22% in a single session, wiping out what was previously described as one of history's most profitable commodity trades.
Quite the story.
But while industrial metals suffered such a dramatic reversal, other commodities actually rallied, defying the broader market sentiment. Where did investors find refuge amidst all this chaos, and what unique factors drove those gains?
Right. This highlights the classic flight to safety dynamic that plays out in times of uncertainty, but also how specific geopolitical factors can drive certain commodity prices, sometimes independently of broader economic concerns. While copper was in free fall, other commodities became highly desirable safe havens or benefited from specific supply concerns.
Okay, who are the winners? Gold, presumably.
Let's look at the biggest winners of the week. Gold futures, exactly. They soared approximately 2% for the week, closing near $3,415 per ounce.
Classic safe haven.
Classic safe haven rally. As the weak jobs report sent Treasury yields plummeting, making bonds less attractive as income generators, and the escalating trade tensions stoked widespread economic fears, investors naturally flocked to the traditional security of gold.
Store of value when things get shaky.
Its appeal is timeless in periods of market stress, acting as a store of value when other assets become volatile.
What else rallied? Oil.
Then there was crude oil, WTI. WTI crude actually bucked the trend of most risk assets, rising a significant 3.3% to close at $67.30 per barrel.
Why did oil go up when growth fears were rising?
Good question. This gain was attributed almost entirely to a ramp-up in U.S.-Russia geopolitical tensions,
Supply concerns.
which sparked concerns about potential supply disruptions from Russia, a major global oil producer. It shows how specific geopolitical events can create their own market dynamics, separate from broader economic fears. The market prioritized potential supply shocks over weakening demand signals in this case.
Interesting. Anything else surprising?
And it wasn't just gold and oil. Even some agricultural commodities showed resilience or unique strength. Live cattle also showed strength, with August live cattle futures gaining $3.65 for the week, supported by a firming cash market, indicating healthy demand for meat.
Okay.
And in a notable, almost surprising move, lumber was the best-performing commodity of the week, rising a significant 11.25%.
Lumber. Why?
Could be attributed to ongoing supply chain issues or specific regional demand. It shows that even amidst macro turmoil, some micro-level supply-demand dynamics can create significant outliers.
And what about the laggards? Where did the economic headwinds and the escalating trade war really make things tough in the commodity space, directly impacting producers and consumers alike?
This shows us the direct, painful impact of trade policy on specific sectors, especially those heavily reliant on global markets and exports.
Like agriculture.
Agricultural commodities, in particular, were hit very hard by the week's events, creating a dire situation for the Farm Belt.
What factors hurt them?
The combination of an escalating trade war, which directly threatens demand from key export markets like China and India, and a strengthening U.S. dollar.
Making U.S. goods more expensive abroad.
Exactly. That combination created what was described as a toxic environment for the Farm Belt. These two forces compounded each other, making it harder for American farmers to sell their products globally.
So which crops were hit?
As a result, major agricultural staples like soybeans, corn, wheat, and cotton all posted significant weekly losses as these macro headwinds intensified.
How bad were the losses?
For instance, soybeans were down 37 cents per bushel, wheat dropped 21.5 cents per bushel, and corn fell 8.225 cents per bushel. These are not small movements for the producers in these industries,
No, that directly hits their bottom line.
directly impacting their livelihoods and creating significant uncertainty for the upcoming harvest season. It vividly illustrates how global policy decisions can cascade down to individual farmers.
So what does this all mean for you as you consider the global economy this Sunday? It's a vivid demonstration that policy changes and geopolitical shifts aren't just abstract concepts debated in distant boardrooms.
Not at all.
They directly impact the price of everything, from the copper in your electronics to the food on your table, ultimately connecting the global stage to your grocery bill.
A very clear connection.
As the market churned through this perfect storm, grappling with weak economic data and a sudden shift in trade policy, investors started making some very clear, almost instinctive choices about where to put their money.
Or where to pull it from.
Or where to pull it from, yeah.
Yeah.
We saw a classic defensive rotation at the sector level, which is a common play in times of severe uncertainty.
Textbook move, really.
So as this new, more pessimistic reality set in, Where did capital seek refuge, and what segments of the economy got punished the most?
Well, if we connect this to the bigger picture, this rapid rotation provided a clear window into the market's new, more pessimistic mindset and how investors were positioning themselves for a potential downturn, or worse, a recession and prolonged trade war.
A flight to safety within stocks.
Exactly. It was indeed a textbook example of a flight to safety within the S&P 500 sectors, a strategic reallocation of capital away from risk.
So who was the winner? Utilities?
The utility sector was the clear winner. It stood out as the only one of the 11 major S&P 500 sectors to finish the week in positive territory, gaining 1.53%.
Only one in the green. Why utilities?
This performance highlights their profoundly defensive, non-cyclical nature. Utilities provide essential services like electricity, natural gas, water, regardless of the economic climate.
People always need power and water.
Exactly. People need these services whether the economy is booming or contracting, making their revenues stable and predictable. This stability, coupled with their often attractive dividend yields, made them a prime destination for capital seeking refuge from the storm.
Stable returns, less volatility.
They offer stable returns and far less sensitivity to economic swings compared to other sectors.
Okay, so if utilities won, who lost the most? The cyclicals.
Conversely, yes. The sectors most sensitive to economic growth were severely punished, bearing the brunt of the market's newfound fears. Basic materials was the worst performing sector, plunging a staggering 4.96%,
Wow.
while consumer cyclicals dropped 3.79%.
Why are they so vulnerable?
These sectors are highly dependent on a healthy economy, robust consumer spending, and open global trade. Think about companies that produce raw materials for manufacturing or sell discretionary goods like cars, high-end apparel, travel services.
Things you buy when you feel confident.
Exactly. They're particularly vulnerable to news of a weakening labor market, which directly impacts consumer confidence and purchasing power, and an escalating trade war, which disrupts supply chains and raises input costs.
And energy, how did that sector do?
The energy sector also faced significant headwinds. Analysts projected it would report the largest year-over-year Q2 earnings decline of all sectors at -24.0%.
Minus 24%. Ouch. Why so bad?
Primarily driven by lower oil prices compared to the previous year and the uncertainty surrounding global demand. This shows a clear and decisive shift away from growth-oriented and economically sensitive sectors towards more stable defensive plays.
Investors prioritizing safety.
Prioritizing capital preservation over aggressive growth, absolutely.
It's fascinating how the macro outweighed the micro this week. Many big tech companies actually had strong earnings reports beating expectations.
These are really good reports, yeah.
But it didn't seem to matter much for their stock prices. What's the critical takeaway here for you about how markets behave in times of systemic shock?
This raises an important question, right? What happens when strong company fundamentals meet systemic market shocks?
Yeah.
The week was a major one for corporate earnings, with strong reports from tech behemoths like Microsoft, MSFT, and Meta platforms, Meta, initially providing some much-needed market support.
But it didn't last.
No. The events of the week demonstrated a crucial market dynamic. In times of systemic shock, company-specific fundamentals, what we call the micro, very clearly take a back seat to macroeconomic and geopolitical events, the macro.
The big picture overwhelms the detail.
It's like trying to judge the performance of a single ship when the entire ocean is experiencing a tsunami. The ship might be great, but the wave is bigger.
Can you give an example? Amazon.
Take Amazon, AMZN, as
Yeah.
a prime example of this phenomenon. They reported better than expected revenue and net income late on Thursday.
Which normally would be great news.
In a normal, stable environment, this kind of positive news would almost certainly have sent its stock higher, possibly significantly.
What instead?
Instead, Amazon shares dropped a painful 8% on Friday.
8% after good earnings. Why?
Investors were not selling Amazon because of its earnings. They were selling the entire market because of a perceived sharp increase in systemic risk stemming from both the disastrous jobs report and the sweeping tariff news.
So it was macro fear, not Amazon's results.
Exactly. Now, concerns about slowing growth in its Amazon Web Services, AWS, cloud division, relative to Microsoft's Azure also played a role.
Okay.
But the overriding factor, the one that truly drove the price action, was that macro-driven market panic.
So the focus shifted.
This clearly shows that the market's primary driver had shifted from identifying which individual companies were executing best or posting strong results to much broader concern. How to position a portfolio for a potential economic downturn or a global trade war.
From seeking growth to seeking survival.
The focus moved from individual performance to overall market survival
Right.
and navigating systemic risks.
Yeah. So amidst all this carnage where broad market indices were plummeting, were there any individual stocks that managed to buck the trend and find themselves in positive territory?
There always are a few.
And conversely, who got hit particularly hard beyond the general market downdraft, perhaps because they were already facing specific challenges?
Even in a broad, indiscriminate sell-off like this one, there are always unique stories. Companies with strong enough individual performance or specific tailwinds to defy the general market direction. These are the exceptions that prove the rule of macro dominance.
Okay, let's hear about some winners.
Among the gainers, Monolithic Power Systems, MPMP, a power management chipmaker, was a standout performer. It surged more than 10% on Friday alone.
Wow, 10% on Friday. Why?
The company reported second quarter sales and profits that not only surpassed analyst expectations, but crucially, issued a rosy outlook for the current quarter, signaling strong underlying demand in its key markets despite the broader economic concerns.
So strong fundamentals won out there. Any others?
Another interesting gainer was First Solar, FSLR,
Mm-hmm.
a solar panel manufacturer, which jumped 5.3%. They also reported stronger than expected sales and profits and raised their full-year sales forecast. And their CEO, Mark Widmore, explicitly noted that shifts in U.S. trade policy have actually strengthened First Solar's competitive position.
Ah, tariffs helping them against foreign competition.
Likely, yes. It probably makes foreign competitors' products more expensive due to new tariffs, effectively creating a protective moat around their business.
Interesting twist. One more winner.
And finally, Reddit, RDDT, the social media company, saw its stock jump a significant 17% after it reported strong revenue driven by a sharp increase in user numbers.
Big jump for Reddit.
This was a clear example of a positive micro story, a company executing well that managed to cut through the overwhelming macro noise.
Okay, now for the losers, who got hit particularly hard?
On the other side, among the losers, Eastman Chemical, EMN, a specialty chemicals provider, was the worst performing stock in the S&P 500 for the week. It plunged a staggering 19% on Friday alone.
19%. Oof.
The company reported second quarter sales and profits that declined year over year and fell short of analyst expectations, which is a clear sign of weakening industrial demand reflecting the broader economic concerns.
Highly cyclical, exposed to the slowdown.
The business is highly cyclical and
Right.
directly exposed to manufacturing and construction slowdowns, yes.
Oh,
Albemarle, ALB, the world's largest lithium producer, dropped nearly 11% on Monday.
why, Albemarle, lithium prices.
Exactly. They've been struggling with a prolonged slump in lithium prices, caused by a global oversupply of this key battery component. A challenge separate from the week's events, but certainly compounded by the general market negativity and fears of a slowdown in electric vehicle demand.
And Coinbase, crypto got hit too.
And Coinbase Global, COIN, the cryptocurrency exchange, plunged 17% after its quarterly earnings fell short of Wall Street expectations.
What was weak in their report?
Their report showed that both transaction revenue and subscription revenue fell from the previous quarter, a worrying sign for a company deeply tied to the volatile crypto market, which also tends to suffer during broad risk-off environments.
So what does this all mean for you as an investor or someone simply observing the markets? It means that while the big macroeconomic picture often dictates the overall market direction and creates broad waves of sentiment,
Sets the tide.
strong company-specific news can still allow some individual stocks to shine or conversely magnify the pain for others already facing challenges. It's a reminder that even in a storm, there are always individual stories to uncover.
But the tide lifts or sinks most boats.
Exactly. Hashtag tag outro. Well, that was quite the deep dive into a pivotal week that truly shook the foundations of market confidence.
It certainly was pivotal.
The tumultuous final week of July 2025 truly marked a profound and decisive shift in the market landscape. The wall of worry investors constantly climb has definitely been rebuilt, resting on new and more formidable fears than before.
Indeed. And if we connect this to the bigger picture, the primary concerns are no longer solely focused on inflation or a hawkish Federal Reserve,
Which dominated for so long.
which were the dominant narratives for so long exactly. Instead, the market is grappling with the twin, interconnected threats of a sharp economic slowdown, made palpable by the shockingly weak jobs data, and a chaotic, potentially stagflationary global trade war unleashed by the administration's sweeping tariff order.
Much broader, more complex risks now.
These are much broader, more systemic, and Arguably more complex risks to navigate, yes.
The market has clearly entered a new, more dangerous phase where macroeconomic and political risks have forcefully reasserted their dominance over corporate fundamentals.
The macro is firmly in charge again.
That shift from seeking growth to seeking shelter, from focusing on individual company performance to the overall health of the economy and the stability of global trade, is a really important one for you to understand, especially as you think about your own financial future and the broader economic landscape.
This raises an important question for everyone listening. What's next for investors, given this dramatic shift?
Yeah, what happens now?
Market volatility is almost certainly likely to remain elevated for some time, as market participants grapple with this new reality.
More choppy waters ahead.
I would expect so. Investors will be intensely focused on any and all commentary from Federal Reserve officials, searching for clarification on how the central bank intends to react to the rapidly deteriorating labor market picture.
Will they cut now? Will they wait?
Will they move quickly now, or will they maintain their cautious stance, risking falling further behind the curve? That's the key question for the Fed.
And geopolitics?
Geopolitical headlines, especially any retaliatory measures or responses from the 92 countries targeted by the new U.S. tariffs, will also be a primary market driver.
Watching for the fallout.
Exactly. The period of serene confidence is definitively over. Investors must now navigate a far more treacherous environment, one where the risks of a policy mistake or a geopolitical miscalculation have risen dramatically.
It feels like a headline-driven market now.
The market is now much more of a risk-on, risk-off environment driven by headlines rather than predictable fundamentals.
So what does this all mean for you to mull over this Sunday, perhaps over a second cup of coffee?
Lots to think about.
How does a week like this, where policy decisions and data revisions cause such dramatic and immediate shifts, change your perception of market stability and predictability? And how do these seemingly distant events, from trade policy to job numbers, ripple through every part of the economy, right down to the price of consumer goods in your local store and the stability of global supply chains?
Something to think about as you contemplate the profound interconnectedness of our world.
Indeed. A lot to digest.